Hey, Kim Bartley from Canopy Mortgage. It's a balmy 72 here in Las Vegas. It's shorts and golf weather. Hey, this news has just come out. You've probably heard that the Federal Reserve cut another quarter point in rates, similar to what they did in September and October. So this is a slow, gradual easing trend, not a big emergency slash of rates. But here's where it gets interesting. The vote inside the Fed was split. One member wanted a bigger 0.5% cut. That'd been nice. And two members didn't want any cut at all. They can take a hike. But that's the biggest disagreement we've seen inside the Fed in years. So what does that mean for you and for mortgages? First, mortgage rates, as you know, and I've told you, do not move in a straight line with the Fed funds rate. They follow what investors expect for inflation and the broader economy, and just not what the Fed does in one single meeting. Because this cut was widely expected, a lot of it was already priced into the bond market. That means mortgage rates may not drop overnight just because the Fed moved by a quarter point. In fact, on some recent cuts, mortgage rates have actually stayed flat or even ticked up a bit as the markets react to the Fed's comments, not just the headline. Second, the outlook the Fed gave for 2026 really matters. Right now, they are only projecting one more small cut in next year, and some members are still arguing that no more cuts or even a possible hike may happen. That tells you that the Fed is convinced that inflation is not fully tamed. This means you will likely see windows of opportunity where rates dip and then bounce rather than one smooth decline. Most projections I'm reading right now is that rates today will be what rates will be next year. So don't make a decision or wait for rates to go down. It's just not worth it. If you want to find out what rates are today, live, 24/7 for your exact scenario, visit kenbartley.com.